Have you been thinking that you need to save money better or get a higher interest rate when you save or start investing? Have you been thinking about these but don't know where to begin? In today's video, I'm going to talk about where you can begin, what is easiest, what is the least risky ways to begin investing. Hi friends, welcome back. If you're new here, my name is Jen. On this channel, we discuss frugality, minimalism, finance, and also a little decluttering. So if you're new to investing, there's a lot of jargon, there's a lot of confusing talk about it. There's a lot of how do I begin? What kind of stocks do I pick? I'm going to break it down so it's simple. Very, very, very simple. Very easy to begin. One of the first things we'll look at is what is investing and why do you want to invest? At its core, investing is putting your money to work for you so that you can build long-term wealth. And why? Why do you want to do that? Well, if you throw your money into a regular savings account, what's the interest rate? Have you looked at the interest rate? 0.01, 0.0025. I mean, it's regular savings accounts. The interest rate is extremely poor. What's the rate of inflation? I'm sure you've heard it's like 2 something or other. I don't think that's the actual inflation rate, but if the inflation rate is 2%, but you're only gaining 0.01 on your regular savings account, what's that doing to your money? Think about that. Regular savings accounts don't keep pace with inflation. So when you park your money in a regular savings account, you're losing money over time. Your buying power is way less than if you were to go into something else. At the very minimum, I would recommend looking into a higher yielding savings account. And, we'll discuss that in future videos, but saving and investing are kind of two different things, which we can talk about later. What I'm talking about will create future wealth for you. It can help you depend less on stuff like Social Security. It can help you when you're getting into retirement, where you don't necessarily want to work all the time. If you want to work, you can work on your terms. You'll have some extra money around if you are investing, and depending on how much you invest. Opening up a brokerage account is pretty simple, and you don't need a ton of money to begin. There are places such as Fidelity, Vanguard, Charles Schwab. Everything these days is now kind of internet based. You can easily get it on the internet. There's also apps. A lot of these companies have apps anyways, but there's ones like Webull and some other ones that you can trade. Oh, and Robinhood. I don't want to forget Robinhood. I don't know if they actually have a website. I have them on an app. So there are various things. You don't need a lot of money to put into these. It's kind of just as simple as going into a bank and opening up a savings account. You open up your brokerage account. A lot of these brokerage accounts allow you to buy partial stocks. So if you want to put $25 in it and the stock is, $300, you can buy $25 worth of the particular thing that you're going to buy. So you don't need a lot of money to start out. It's not like you need to park $1,000 or $5,000 or anything in these accounts to begin. One of the biggest things to remember is to be consistent and to have patience. Investing is something that is for the long haul. It's not a get-rich-quick scheme. The stock your drinking buddy is telling you about, yeah, I would be very careful with something like that. I'll explain to you the kinds of things that I'm investing in, which are not what my drinking buddies invest in. So, for beginners, and I'm a semi beginner as well, I like to invest in index funds and ETFs. ETFs are exchange traded funds. That's what ETF stands for. They are very similar to index funds in where a they're a bucket of stocks. So when you invest in an ETF, you invest in a bunch of stocks. You're not investing in only Apple, only Tesla, only Microsoft. You, depending on which ETF or which index fund you choose, you're investing in multiple companies. You can be investing in hundreds and thousands of companies. And the whole thing with investing in ETFs and index funds is it lowers your risk. I mean, it's not 100% of a lower risk, but if you think about it, even when the stock market has done very, very poorly, unless the stock market is going to do, the stock market in its entirety is going to do very poorly for a very long time, you've got to think about the patience aspect where you're letting your money work for you over time. You're not investing in these things to pull it out in a month from now, maybe even not even a year from now. You want to keep these in here for a little bit longer. And if you do need to pull your money out a year from now, there are products that you can invest in or put your money into that work for type of um, that type of saving. Over the long period of time, index funds have trended upwards. There are times, such as like say 2008, when the market crashed, and I don't know how long it actually really crashed for, maybe a year. I don't really know because I wasn't overly invested at that point in time. But when the pandemic when the pandemic happened around 2000, there was a market crash. It didn't last very long. It was extremely short, and I wish that I had been investing more what I do now. I wish I had been thinking about investing at that time, because if the market does do a crash, that's when you wanna buy more. But you also have to be careful not to try to time the market and wait to put your money in until that happens. Over the course of time, the stock market is going to go up. So, even when the crash during the pandemic happened, it didn't go down very far and it didn't stay for very long. And most stuff bounced back up. Even the stuff that didn't bounce all the way back up is still up. It still went back up. So it wasn't like you're losing all your money and you're going to go broke. The nice thing about investing in ETFs and index funds is you're not, like I said, it's a bucket of stocks. You're not investing in one particular stock. So when, yeah, your drinking buddy's stock goes into the gutter, you got a bucket of them. And not all of them are going to go into the gutter. An index fund will have something like, you can buy index funds that are total stock market index funds, and that invests a little bit in every single company that is in the stock market. So you are, I shouldn't say guaranteed, but you are very, very much going to be getting a higher interest rate on your investments with something like that than when you buy a particular one stock. And that's where you get the risk, and where all the hype about the risk comes from, is when you're picking stocks and buying like one particular stock. With ETFs and index funds, it's the lowest risk and one of the safest things to invest in. Plus, it's very simple for beginners. You don't need to look at the stock market. It's kind of like a set it and forget it. You put your money into it and you buy into whatever the thing is, and you just let it go. You don't need to worry about it because you're invested in so many things. You don't need to look at the ups and downs of this stock and that stock. The thing with investing in index funds and ETFs is that you don't need to buy a lot of them. You can pick one that you like and you can put your money into one. You could pick two, you could pick three, and you don't need to buy a lot of stocks. You don't need to worry about diversifying when you buy an ETF because it's already pretty much diversified depending on what you choose. An extremely popular one is the Schwab index or the Schwab ETF, which is SCHD. That is extremely popular. A lot of people put their money into that. That is one that gives you a dividend. So on a quarterly basis, it pays you an interest payment. Plus, it also grows over time. The thing about something such as the SCHD is the managers of that ETF go and they look at what industries and what stocks they want to put in that fund, and they switch those up on a regular basis. So SCHD is an ever-changing one. The managers for those funds are actually looking at the stuff and they're doing the work for you. They're doing the analytics. Another thing that I like to invest in is the VTI ETF, which follows the Vanguard Total Stock Market Index. And that has like around a 9% interest. It depends on the market. Sometimes the market's up, sometimes it's down. I've seen where it'll return, 16, 17%. I've seen where it's less than that. On average, index funds are around, say like 8 to 10%, which is generally more than inflation. So your money, when it's in that, is definitely going to be outpacing inflation. The thing with investing in ETFs or index funds is it's like the minimalist clutter-free version of investing. You're investing in one thing and it's stress-free. You don't need to worry about all the things that are invested in this bucket because that's up to the managers of those funds to worry about that. You just keep putting your money in, and for the most part, it's going to outpace inflation and you're going to end up ahead. And the whole thing with investing as a beginner is that's what you want. You want to start simple. You don't want to get into investing into complicated things. It's it's going to create resistance for you. If you find that you want to invest in this company and that company and this other company and that's a lot to have to think about. And then when you hear bad things about this one particular company, it goes in your brain and creates worry, and you want it to be simple and easy and flow smoothly. Even though the stock market doesn't flow smoothly, there's a lot of ups and downs. If you have ETFs and index funds, you don't really need to think about it. Just keep investing in it. And there's easy ways to do that. If you set up an account and you have a direct deposit from your job, you can have your direct deposit go into whatever your brokerage account is, and then you can just have it automatically invest in the particular funds every time your money goes into what they'll call the general fund. And even if your money hangs out in the general fund for a longer amount of time, the general fund is generally got quite a bit of a higher interest rate than a regular savings. I think a lot of brokerage accounts, the general fund is more funded by something which is a bond. And bonds are a lower interest rate bucket to put things in. They're not intended they're not intended for growth such as index funds. They're more intended to hold your money at a rate that is above, like just a little bit above or right around where inflation is. So they are a safe place if you do want to park your money into a general fund that is in the bonds. as opposed to putting money into a savings account that is getting you 0.01%. I encourage everybody to begin investing. Just invest in something simple. Start somewhere safe, start slow, but start consistently. And remember, there's never going to be 100% zero risk. There's a risk involved in everything. And in my personal opinion, I feel that stocks and ETFs can mitigate that risk, and they are a better place to put your money. They are a better way to gain money. I will add a disclaimer here that I am not a financial advisor. This is just what I do personally for my own investments. You'll need to do your own research to determine whether or not you feel that it's risky or not. It is, your own discretion. I'm not telling you what to do. I'm just showing you what I do that's simple, and I consider myself somewhat of a beginner in investing. If you like this video, please hit the like button, and if you want to see more content like this, please hit the subscribe button. My name is Jen. I thank you for watching. I'll see you in the next one.